All right, ready for the last one? So any questions you have before we start? So let's have a quick overview of the example, right? So it's gonna be 20 MCQs. And you know you're only allowed to have 10 calculators. So final exam is you have more time, hour and 50. And I think you know the rule, like if you can come early, settle down, you can start early. And also you could have some more minutes in the test, right? So no worries, it's not a time game. You should have plenty of time, but make sure you use the time, okay? If you finish early, I have no benefit. But if you finish early, get a 4 grade for finishing early, that's your loss. Make sense? Use the entire time, try to do well, and that's all. And on the test, you can scratch like pretty close to the test, pretty close to the problems. You can scratch. There is one entire white paper and scratch there. But make sure on the answer sheet, on the very last page, make it clean, neat, and tidy so that reader can know what you meant. But other than that page, you can do whatever you want to do. Make sense? And for this class, I think our test is this one, right? May 11, 7:30, 9:20 is right. And this is also mentioned on the syllabus, I believe. So any questions on the example? Yes.
Is there any way non-graphing calculators?
Even to the very basic, like just for calculation, that should be fine.
Like this?
But no graphic calculator word if it's there. That should be fine. Very basic should be fine. That scientific calculator, just for calculation, that should be fine. But no TI graphic. Make sense? So any other questions you have? Exam policy. So for the final exam, I'm planning, I may visit once or twice, okay? If you feel like you are not happy with the what TA is helping you, so I'll be there once or twice. So if you feel you need to talk to me, you just keep doing, accept the problem, you have problem, wait on me, I can come, I can talk to you, okay? So I'm planning to visit once in the beginning of the test and maybe once in the middle of the test. So if you have any confusions for anything, you can talk to me. Anything else? So do you have any questions on the topics I have listed? Anything you have for me? So let's have a quick review then, one by one. So from chapter 16, my expectation, you should be able to know how to calculate all those time development things like present value, future value, record rate of return or rate of return, payment, number of periods for lump sum, for annuities, perpetuities, during perpetuities. So when you say lump sum, that means one cash flow, right? One cash flow of the entire period. The cash flow could be today. You need to find the future value. The cash flow could be future. You need to find the present value, right? When you say annuity, series of cash flow, say finite series of cash flow. Be careful. Finite series of cash flow, equal amount in equal time frequency, right? That is for annuity, right? Perpetuity, it's not a finite series of cash flow, right? But equal amount in equal time periods. During perpetuity, the cash flow will grow at certain rate, right? So make sure you know how to calculate those problems. You could see some direct problems asking you calculate future value or calculate present value or calculate rate of return. Or this is gonna be helpful to find bond price today, bond value today. Make sense? Stock value today. So there are both direct and indirect problems related to the first topic I have listed. In the slide, there are numerous examples we did in the class. Make sure you know all those examples. That should be fine. Know the definition, like when you say annuity, what does it mean? Finite series of cash flows, equal amount with equal time frequency, right? Perpetuity. Only difference is not a finite series of cash. It is forever, right? Know the difference between annuity due ordinary. One will start from today, like beginning of the period, the other will start from end of the period. That's the difference. So when we say annuity due versus annuity ordinary, the only difference is the timing, beginning versus ending. But the number of cash flow is same for both of these, right? Sometimes you get confused. If it's beginning of the cash flow, that means the number of cash flow is one less than the stated, but it's not true. Number of cash flow is always same, annuity due versus ordinary. The only difference is timing. One starts beginning of the period, one starts end of the period. EAR versus APR. APR means annual percentage rate. Annual percentage rate. Whenever we see any interest rate, maybe you want to deposit money in the bank, maybe you want to borrow from the bank, whatever they're stating explicitly, that is APR. But depending on the loan type, depending on the investments, you may be paid or receive your return in monthly, quarterly, semi-annually, annual frequency, right? On that case, the effective rate you are paying or generating is not the APR, it's something different. So EAR actually tells you how much effectively you are paying or receiving annual basis. On the other hand, whatever rate that is stated explicitly in the terms and conditions page, that is APR. Make sense? If I say that the investment opportunity I have 5% rate of return, that's APR. But that investment sets may give you monthly payment, quarterly, semi-annual. Depending on that, you could have a different ER, right? So if you go to the slides, you can see the formula, right? ER versus APR. I've also pasted the copy and paste the formula on the formula sheet for the test. So feel free to go over, right? Finally, just know the definition of these three topics, three different types of loans. So when you say pure discount, pure discount. And let's say this is face value. Right? Any corporations and government want to issue $100 face value of bond, let's say, for T time period, could be 1 month, 2 months, 3 months, 1 year, let's say. So the loan will be issued today, less, more or equal amount of face value. Pure discount loan. Dottie?
Yes.
Absolutely. So the loan should be issued today. Anything below 100 could be 99, 98, 97. So today the price should be anything less than 100, anything, okay? And this less is known as the discount. So the definition when any loan, when any debt instruments issued today at a discount of the face value, this is called pure discount. And pure discount loan never pay any interest, never pay any coupon, to be specific. Coupon rate is kind of zero. Because the difference between discount, or you can say price, and face value is the rate of return for the investors. Make sense? Pure discount loan. Know the definition, not the concept. Interest only. So let's say bond will be issued today, and it has two time period. Let's say T1, T2. So the bond will be issued today at face value. It's 100. Face value. On each time periods, certain coupon or interest, however you're comfortable with, will be paid, which will be 5%, 3%, whatever amount. Only at the end, only at the expiration, only at the maturity, face value will be paid back. Makes sense? Interest only. We borrowed at face value today, and we will only pay interest or the coupon each time frequency. At the end and expiration, you're gonna pay the face value. Make sense? Amortized loan. The loan or bond will be issued today at face value, right? But each time frequency, there will be payment. Okay? Each time frequency, there will be payment. That payment includes both interest or coupon plus principal. By definition, amortized loan idea is each time frequency, you make some payments that includes interest and principal, and you are reducing the principal each payment, each time frequency payment. So this reducing word has a specific name in the finance, which is called amortizing. Make sense? This is just a word. Reducing means amortizing. So that's why this is called amortized loan, because each payment I am reducing principal. If you look carefully, we are only reducing principal expiration, right? But for this, we are reducing principal each payment we are making. So reducing here is amortizing. So we are amortizing, and amortizing. Amortized. Makes sense? Know the difference, know the definition. Now, if I want to give an example, pure discount loan is more like you can think about treasury bills. That's the pure discount. Or any zero coupon bonds, short-term zero coupon bond, corporate bond, pure discount. Interest only loan is more like long-term corporate bonds or coupon bonds you talk about. Sometimes bank loan, corporate bank loan, they allow you to only pay interest and pay the entire money at expiration. Amortized loan. When you get a job, you want to buy a house, you want to buy a car, automobile loan. Those are amortized. Make sense? Any questions, concerns? So this is all I want from chapter 6. So all these, what I'm talking so far is also available in the slide, okay? Go and read from the slide too. Chapter 7. Bond definition, right? It's not a bond. What is a bond? You can think out it's a type of interest on its own, right? Today, any corporation issues a bond, and on each time frequency, they only pay the coupon. At the end, they pay both coupon and the face value, right? Know the definition and know how to calculate bond price, right? So if you know from any problem how to calculate present value, you should be good to know how to calculate price, right? So one caution, whenever you are practicing those present value future value thing, make sure practice with different frequencies, compounding frequencies, monthly, semi-annual, quarterly, okay? It's going to help you to calculate bond price if the coupon is quarterly, semi-annual, or annual. For bond price, nothing mentioned. Semi-annual frequency, nothing mentioned. If mentioned, follow this. If you're still confused on the test day, wait with the TA or wait on B, okay? YTM, yield to maturity, right? This is the same thing like calculating rate. Makes sense? If you know how to calculate rate from here, you should be good how to calculate YTM from here into maturity. Current yield. If you go to the slide, easy formula. Current yield basically annual coupon divided by price. Don't get confused. It's price, not face value. Price. At what price the bond is issued? It's price, not face value. And also annual coupon. Maybe the bond issued paid semi-annual coupon, okay? So convert it to annual coupon. Annual coupon is the price. Practice with different frequencies like this. Okay, bond price relationship with coupon and yield. So let's say there is a bond face value $1,000, okay? Right now, for the same bond, let's say maturity 5 years. Let's say for the same bond, the required return on the market or discount rate on the market is, let's say, 10%. Right? %, let's say. So if the corporation decided they will pay coupon more than 10%, without doing any calculation, what is your expectation for the price range? At what price the corporation can issue the bond? Coupon is more than market rate. Greater than $1,000, absolutely. And what kind of bond is that in terms of the issue? Absolutely. So the idea is think of the economic intuition. Don't need to do the math. If someone is offering more coupon than the market, are you interested? Yes or no? We're interested, right? We are more positive about that investment opportunity, right? So we all want to buy that, right? So that means there is more demand. More demand, high price, premium. If the coupon is less than 10%, what price the bond could be issued. Less than 1,000, what do you say this kind of bond? Discount? Because we are excited, because on the market we can see 10% is offered. And the corporation is offering less than 10, maybe 9, 8, 7. Why should we buy that? Just go to the market, right? We are not excited. Lower demand. Lower demand means lower price, discount. So this is discount bond. This is premium bond. And here in different, so this is called par value bond. So that one should be issued $1,000. Make sense? So know the relationship. Price versus reinvestment risk. Go to the slide and read in detail. So price risk means if you buy the bond today for 10 years, your commitment is 10 years because the bond maturity is 10 years. Over the period, if interest rate goes up, you want to sell the bond. Do you think you are able to sell the bond what you paid for or less? Think from the Silicon Valley Bank example. Silicon Valley Bank example. If you buy the one today at 10%, let's say at par value, you buy the one today at 10% at par value. 2 years down the line, the market rate is 15%. Do you think bond price should go down, go up, stay the same? It should go down, right? Because when rate of return goes up, present value should go down, right? So that means the price is going to go down, right? This is called price risk. Also, one of the assumptions in finance is if you buy any bond today and you want to hold it for 10 years, each 6 months, the coupon you're receiving, you should reinvest. You should not consume it, you should reinvest. If after you buying the bond, interest rate on the economy, on the market goes down, that means all those subsequent coupons should be reinvested at lower rate, right? This is called reinvestment. Right? Now let's talk about bond indenture. So all these terms and conditions. Let's see chapter 7. Here. So bond indenture means all the terms and conditions that is included. Okay. So when any page, when any agreement that explains all the terms and conditions of the bond, that is bond indenture. Like what should be the maturity of the bond? What should be the coupon rate, face value, something like that. Along with this, if any property will be used or not as a safeguard, this is called collateral, right? If there is a sinking fund provision or not. Sinking fund provision means each period, it could be 6 months, each annual, the corporation will put aside a little bit of money to this fund so that at expiration, they don't need to manage the entire face value to pay back investors. Having a sinking fund provision is safer for the investors because at the maturity, the probability of default risk is going down because the corporations already have good amount of money in the fund to pay back. Call provision means if the interest rate goes down, whether the issuer, the borrower, has the right or not to call back. If the issuer or borrower has the right to call back, this is called call provision. Good for the borrower, but not good for the investor, right? Protective covenants. Protective covenants, you can think about all those extra terms and conditions that investors require so that they can safeguard. Let's say the corporation is doing well. They generate a lot of cash flows. But the investors, the bond investors, do not want all those cash flows to be distributed to the stockholders as a dividend. They want a portion should be kept within the fund, within the farm, so that in upcoming years, that money could be used to pay interest. In the upcoming years, that money could be used to pay the bond face value. So this is kind of a protective covenant. So any terms and conditions that give the bond investors an extra layer of protective covenants. You can think about protective terms and conditions. This is the word, terms and conditions covenants. Make sense? Now, bond characteristics and required return. So here the idea is very simple. From the last class, we know that more the risk you have, it should be compensated more, right? But only for the systematic risk, right? So here the idea is the same thing. The more the risk the bond has, you should be compensated more. You need more required return. Secured debt versus debenture, debenture has more risk. It should have more return. Subordinated versus senior, subordinated has more risk than senior. Sinking fund with versus without, without has more risk. And then callable versus non-callable, callable has more risk. Okay, more risk the bond has, it should ask for more return. Any questions, Matt? Okay. Now, clean price, dirty price. Corporate bonds, they are traded on the market, right? But corporate bonds do not only trade during the coupon settlement dates. They can trade anytime. So there is a conflict. Let's say there is a bond that pays coupons in 6 months, 1 year, 1.5 years, 2 years, blah, blah, blah. Let's say this way. If the bond is traded only on those settlement dates, life is easy for us. Because the seller keeps the coupon, buyer will keep the next coupon. Seller keeps the current coupon, buyer will keep the next coupon. So life is easy for us. Whatever the price is quoted, is that. That's it. Settlement is done. Whatever is price is quoted, buyer pays the price, but seller keeps the today's coupon. That is easy. However, if bond is traded between the coupon settlement dates, let's say here, who keeps the last coupon? Because here the market quotes a price based on upcoming coupons, right? Market quotes a price based on upcoming coupon. So the buyer should pay that quoted price to the seller, right? So who pays the last coupon? Who keeps the last coupon? Buyer, seller. So the answer is the last coupon will be shared proportionally. The buyer will keep this fraction, seller will keep that fraction. Okay, but on these settlement dates, the seller owns, sorry, the buyer owns the bond. Sorry, wait a second. So on that day, the seller will keep this one, okay, and the buyer will keep the next one. But on the settlement dates, the buyer actually entitles for the entire coupon, right? But how can we settle? So the thing is that if any bond is traded in the middle of the settlement dates, the buyer pays the quoted price, which is known as clean price, plus the fraction of coupon. Buyer pays the quoted price known as clean price plus the fraction of coupon. So this is called clean price plus the fraction of coupon is known as starting price because the seller actually entitled of this fraction of period coupon because he actually hold for this time, right? He actually hold the bond for this fraction of time. He actually owned the fraction of coupon. So that's why the buyer has to pay the quoted or clean price plus the fraction of coupon or accrued interest. Make sense? Fisher effect. Any idea what is Fisher effect? What is Fisher effect?
How you account for inflation?
How we account that? How Fisher told us to account for that? So according to Fisher effect, nominal interest has two components, right? What are they?
Interest.
Nominal interest has two components. What are they? So when you say
Inflation,
inflation and
real rate.
absolutely real rate and inflation. Because when you say interest, that is basically the nominal interest. When you say just interest, so right now, if you want to borrow for real estate, 6.5%. So that is the nominal interest. Okay. So nominal interest has two components: real rate plus inflation. Now, if we say approximately, if you are given real rate and inflation, calculate the nominal interest rate approximately. Use this equation. That's it. But if we say calculate the nominal interest, given you know real rate and inflation, then the function should be, or the formula should be like that. Make sense? So idea is nominal interest has two components, but this is the actual formula. But that can also give you a good approximation. Like quick calculation, long calculation, okay? But both gonna give you something very similar, 90% similar. This is accurate, this is approximate. Questions? Yes,
Will that formula be given to us?
I think so. It's already there. Let's see. Here, right? Fisher effect. This is nominal real inflation. Okay, approximate just. So nominal. So know the notation. Okay. Sometimes we say the actual name, but on the formula it's just a sign or notation. That's not a notation. So 1 plus nominal, 1 plus real, that 1 plus inflation. So chapter 8 is all about stock valuation. I think we learned dividend discount models. So there are like 3 different models. One is, I think, called zero growth, constant growth, and then multi-stage or two-stage growth, right? Right? Go to the slide, we did some problems, those. formula is given on the formula sheet. So just know how to do that. Now finding the R for stock return. So if you can remember, we calculate R from the constant growth model. So if you go to the slide, let's say chapter 8 here. So the idea is annual return from stock is a function of dividend yield plus capital growth or just growth, capital gain, how you want to say it. So in short, if you buy any stock today, 1 year later, you will get some dividend, and also your stock price may go up or down, right? So your stock return from your stock investment is coming from these two sources. If they match, you buy a stock today, over the period you can get some cash dividend, and your stock price will also adjust, maybe go up, may go down, depending on how the corporation take. Two source. That's it. Then features. Know those features. Voting rights means if you buy common stock, you should have the voting rights. You can vote for elections, like who should be the directors. You can vote for any policies. You have the voting rights. Sometimes, if you don't have time, you can delegate someone that can cast a vote for you. That is called proxy or proxy voting. Let's say if you own any stock, but you don't have time, you told your broker to cast the vote for you. Proxy or proxy voting. Classes of stocks. Common stock sometimes has class A, class B. The only difference, they have different number of voting rights. Maybe for class A, if you own one stock, 1 voting rights, class B, if you own one stock, 10 voting rights. That's the only difference. Number of voting rights per share. All are the same. And then preemptive rights. Preemptive rights means for subsequent issues, if the corporations want to issue shares again, they will ask existing shareholders first. Do you want to maintain the existing proportional ownership? Yes or no? Yes, you can buy stocks to maintain the proportional ownership. No, I'll go to outsiders. So preemptive rights means existing shareholders will be asked first. Do you want to maintain the proportional ownership or not? So that is called preemptive rights. So if you have the preemptive rights, you have the right to decide or deny whether you want to buy new stock issue or not to maintain the existing proportional ownership. Make sense? So know those definition and characteristics. So that's it. Chapter 9. We did a lot of problems, right? NPV, IRR, payback, discounted payback, modified IRR, profit areas, right? So just briefly know the definition, how they are different, and also know the calculation. So go over the slide with the examples, one by one. Okay. So most of that, like let's say IRR, modified IRR, I have not given a formula. There is no formula exists. Okay. For PI, I give formula. For all else, I can have given formula. Let's check. Yes, PI I give formula. For NPV, I give formula. Okay. Payback and discounted payback, I did not give any formulas. Okay. So it's basically easy. For payback, each year you're getting some cash flows, just do that, and find out how many years you need. Right? Discounted payback, same thing, but the discounted cash flows. If you feel like you need the formula, basically there is no formula. I'll try to give you something on the test, but I believe you guys can figure it out. Make sense? But I have not given forms for other things. So when you talk about different capital budgeting decision rules, what are the checklists, right? Three checklists, right? Do it consider time value of money or not, right? Do it consider risk or not, right? Do it consider or do it indicate whether it generates any value or not, right? Three checklists. Let's know the checklist. If you want to evaluate LTV, IRR, payback, PI, multiplier, what are the checklists? What are the key criteria you should check to decide which capital budgeting rule you should consider as the primary decision? Three checklists. If three are yes, then the primary decision rule should be considered. Make sense? And then, is there a conflict between NPV and IRR? Two situations, right? Mutually exclusive project, non-conventional cash flows. So if there are conflict, which one to prefer, NPV or IRR? NPV, right? So let's go through the example, right? We did some mutually exclusive projects and conventional cash flows formula, right? So you may not need to calculate anything, but understand the concept. That when should be a problem? If there is a problem, what should I do? Make sense? Chapter 12. Market efficiency. Yes.
For the modified IRR, should we go with three different methods?
Yes. Yes. You should know. So it's the same process, almost the same process, but know the three different methods. Right? Good question. Must know the three different methods of modifier. Chapter 12, market efficiency. So what is market efficiency or what is efficient capital markets? No idea. Yes, yes, next week. Yes.
Whatever the, oh, sorry.
No,
It's whenever the stock price is negative or it's fairly priced.
Absolutely. So the idea is stock price in the market should be fairly priced. And the concept is coming from price should reflect all the available information. That's the key word, all the available information. Because if price reflects all the available information, then it's fairly priced, right? If price do not reflect information, how can it be fairly priced? So market efficiency says on the market, stock price should be fairly priced. Why? Because price should reflect all the available information. Two different forms of market efficiency, right? Weak, semi-strong, strong. So the idea is, if the market is efficient, you are only able to generate returns for taking risk. Or you can think about the market is efficient, you are only able to generate the market return. You should not be able to generate any abnormal, any excess return on top of the market. If you can remember chapter 13, what you learned, you should be compensated for systematic risk. If the market is efficient, it doesn't mean you should not be able to generate positive return. No, that's not true. If we say if the market is efficient, you should not be able to generate positive return. That's not true. You should be able to generate positive return. There is a compensation for systematic risk. There is a compensation for any systematic risk you have taken. What is the systematic risk? Market risk, right? And what is the return for that? Expected market return, right? So if the market is efficient, you should not be able to generate anything excess on top of the market return. If you are able to generate, market is efficient, right? Three different forms. Weak form said market price should reflect historical information. Historical, which is basically price and volume information, right? If you analyze historical information, do not able to generate more than the market return or excess return. Market is weak form of efficient. If you are able to generate, market is not weak form of efficient, or market is weak form of inefficient. Make sense? What is the method? What are the tools to do historical price and volume analysis? No idea. Technical analysis, right? The method to do historical price and volume analysis, right? Semi-strong says that market should reflect publicly available information, like historical price, volume, any news, any earnings announcement, any earnings release, all those publicly available information, right? If you analyze publicly available information, do not able to generate, semi-strong form of efficient. Able to generate excess return, semi-strong form of inefficient. Make sense? What is the method to do publicly available information analysis? Method, tools. What is the name specifically? Fundamental analysis, right? Strong form said both public and private information should be reflected on the market price. Make sense? All those things are mentioned in the slide. Just go and read and know the idea. What makes market efficient? Two-step process. Do research and trade accordingly. If you just do research and trade nothing, market will not be efficient. If you trade randomly, market will not be efficient. Do research and trade accordingly. That means if you're doing research and find that you need to buy, there's some buy orders. If you do some research and find that you need to sell, then sell in existing holdings. So do research and trade accordingly. That actually making money efficient. Make sense? Any questions, chapter 12? Chapter 13. Just do these problems we did in the class. Expected risk, expected return. Formula will be given. Just do the problems. So different types of risk. In the last class, we learned that total risk measured by, what is the proxy? Standard deviation, right? Or sigma, right? Has two components. What are they? Good job. Systematic system. How we measure systematic risk? What is the proxy? Beta. And non-systematic. This is also known as what? Market risk, non-diversifiable risk. This risk you cannot diversify, you have to accept. And you should be compensated for this risk, right? Diversifiable, farm specific, asset specific risk. If you allocate your capital in numerous stocks, in numerous different types of stocks, you should be able to diversify this risk, actually eliminate this risk. So that's why you should not be compensated for this risk, right? To know these things. So the benefits of diversification is you can eliminate unsystematic risk. That's the benefits. And you should not be compensated for that. We know beta, right? We know risk premium. Anything we earn on top of the risk rate is risk premium, right? We know CAPM, capital asset pricing model. And the capital asset pricing model say that if you invest anywhere, you should earn risk-free rate plus the risks you taken, which is beta times market risk premium, right? So know the concept. So any questions you have? Yes.
This is when it's like a whole, but we should like study each chapter about equally, or will like more have the topics after more?
That's a good point. So if you get the difference, so when I make the test, I try to make questions coming from almost equal from these chapters. Almost, like it's tough to make them almost because you can assume 20 MCQs coming from 1, 2, 3, 4, 5, 6 chapters. So I cannot make it exactly equal, right? But almost equal. But this is a good list of topics that are going to definitely help you to cover all these 20 MCQs. Make sense?
Is there a good chance the file will be curved toward the next?
I don't know yet. It depends on what is the chance of how you guys are doing. If you all get 100, why I should fail? And there should not be any surprise like the midterm. If you go back, look the topics I listed on the midterm, and if you can think of what the problems came in the midterm, there is no surprise. And there should not be any surprise too. If you struggle regarding any wording, if you struggle regarding any like the way I phrased it, it could be possible because on the very first class I told you that one of the major challenges to study finance is word. Same thing has so many different names that also takes me 5 to 10 years to learn. The first class. Okay. So if you struggle that, it is possible that TA do not know. Just wait on me. Okay. I'll try to come sometime in the beginning and sometime in the middle. Feel free to talk to me. Okay. So any questions you have? If you have no questions, then pack your bag and everything. I will hand out the quiz if you are interested. Okay.
Do we need a copy?
No, I don't think so.